The information in this podcast is current on the day of recording. It is general advice only and does not take a personal situation into account. It may not be suitable for you.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is Research Director Nathan Bell. Hey, Nathan.
Hi, Gaurav.
And with us also is analyst John Addis. Analyst, founder, editor,
and
life of the party.
Cripple.
And cripple, yes. All those things in maybe different orders. John, how are you feeling?
I'm pretty good, thanks. Pretty good, yeah, considering.
Yeah.
I had my hip replaced 2 weeks ago and I'm walking around just about. Going to the toilet is interesting, but other than that, absolutely fine.
Good to hear.
You won't hear the stuff anywhere else, folks.
No, this is riveting stuff. We probably lost half the audience just there.
That's
When
right.
you mentioning your toilet trips, they're gone after that.
That's right. This is my near-term future, so it's disappointing to hear it already.
You know, I was thinking the same thing. I was looking at John thinking, geez,
Yeah,
what's going to be us?
15 years' time.
Ooh, I know. The long term, who wants it? Nath, you've had a few things on your mind, actually. We've stopped your ranting so you could keep it on for the podcast. So this is your chance. We're going to clear the deck and tell us all your thoughts. I mean, we've been sitting around waiting for a market correction. Stanley Druckenmiller scared the pants off everyone several times, warning of a market collapse. As a fund manager, what are your thoughts about that? Do you sit there holding cash? How do you react to fear?
I just recorded a webinar for our growth fund that's doing its secondary offer, and I think I added more fuel to the fire, scaring everyone that InvestMart was going broke by accident.
True to form, Nathan.
Nice one. Yes.
I was just trying to make the point that, you want a nice, healthy business behind the funds. And I think I intimated that InvestMart had financial issues, but certainly not the case. Just talking about, how we grow our business and by having these secondary offers and, some of the investments and we want to make in the business and so forth. So that probably hasn't helped the mood of anyone listening to that. But I just thought, I know for a lot of our members and investors have been with us for a very long time. They've been through lots of cycles, but it's a really difficult environment at the moment because, the market never gives you what you want. I get the sense from a lot of investors that there's almost like a sense of injustice that the market hasn't fallen and we've had this big broad buying opportunity. But the thing is, when you go through them, they're never as fun as what you make out in your mind. It's like that means something's gone really wrong and you've got a lot to think about, and there's probably stress from other places like losing your job or friends losing their job, and that whole thing where they say what's the difference between a depression and a recession. And depression's when you lose your job. So and the other thing I've been thinking about too is just over time the market is very resilient. It actually takes a lot to knock the market over. But what I find personally a little bit frustrating at the moment, I don't really get frustrated. I don't like seeing my own personal wealth go down with Frontier at the moment. That's not fun seeing that thing go down 10% every day. And another little software company owned in Canada looks like it's going broke. So I actually feel like I'm having my depression at home, but it's really got not a lot to do with sort of general advice and the funds at II and whatnot. But I think you've got a few options at the moment, one or two options that you haven't had for quite a while, which is to earn a somewhat decent return in fixed income or just, in a bank account. And I know, friends of mine are just moving their money around for like Macquarie's cash account, for example, where I think you get 4% up for your first $250,000. So I know people may not want to open up new accounts under all their sort of different family trusts or personal names or whatever, just for the sake of an extra percent, which they might invest in the market at any time. But I just think there's those sort of things to think about. Like obviously US bonds are yielding much more than Aussie bonds, but if you buy them, obviously you open yourself up to currency risk. So, probably not the area I would go to, but it's an option that hasn't been there for a while. But you actually may work out that the bonds go, if interest rates do go down, then, that's good for bond prices. So there might be capital gains there still. That's just one option. But I think the other one is everyone wants to, there's a great quote by this UK fund manager. I think it's something Anthony Bolton.
Anthony Bolton.
Anyway,
Definitely not Michael Bolton.
and he
no
says,
good quotes from there. Yeah.
And he said, investors always want to do today what they should have done yesterday. And I love that quote because, we all want to have bought REA Group 10 years ago and CSL 10 years ago. And we all think, we're going to get this big broad buying opportunity and then we can load up the portfolio, buy all these great companies. And And the thing is, you get into the downturn when it comes, and all of a sudden there's just other things happening, and there's other cheap stocks, and your mind goes, oh, this is much cheaper, and you end up spending time on that. And particularly as a professional like us, when you go in that period and you've got all your stocks to cover in the newsletter and funds to get the stocks right and whatever, there's a whole lot going on, and it's hard to do new research. So, this nice idea we have in our head about doing all these nice, sensible, well thought out things sort of get thrown out the window in a way when the real pressure comes. But to get in those, you think about what it actually takes to get share markets low, with cheap share prices, like something like the GFC was like I think a once in a lifetime thing. I don't think we'll ever see share prices that cheap again, not in my lifetime, unless the actual financial system completely comes apart this time, which, is a non-zero risk. But you can't sit there and invest for that. You've got to invest with, some sort of normalcy in markets. And so I think you've got a few options at the moment. If you were young and you're wanting to take the risk, like I'd be spending all my time in smaller micro caps, because it's just where I think there's genuine value, and there's a lot less people covering those stocks now. Funds are going out of business. There's institutional, big financial institutions that used to have analysts that cover small cap don't cover it anymore. No one wants to own micro caps in this environment, and anything cyclical, like there's all these sort of reasons why people aren't covering them. But if you look at the index, and maybe you've owned an index fund and you're happy with that, like you've got to lower your return expectations. I know even you and I, Gaurav, have talked about putting a sell on BHP. If the iron ore miners are expensive, and the banks are also pretty expensive, and three of them of the big four have produced virtually no capital gains since 2002, which I find incredible. So they're not growth stocks, and you're lucky to get the dividend yield, plus your franking credits over time. So there's like 40% of the market. We don't want to own A-REITs because they're just not very interesting, and they've got problems of their own. There's another 20% of the index, CSL 7. So there's about like 70 or 3/4 of the market. And like none of those, CSL is actually, funnily enough, the most interesting out of all of those. But they're not the places you want to look. But the question is, are you going to be happy to take let's just call it 6 or 7% annualized return, or do you want to try and chase the 9 or 10% plus? And how do you go about doing that? But I just think the one, and this is what Druckenmiller, I think, alluded to, I think the one thing he said at the moment is the one thing you don't want is you just don't want to have one big idea or like real compulsion and absolute faith in one or two big ideas. He said, like, it's just not the time for that. It's just so complex out there at the moment. So many things could go wrong. And I just think this is why people are sick of hearing it. But, our approach is we've got 80 to 85% of the funds or portfolios invested, a little bit of cash for a couple of new ideas. We're surely we always get 2 or 3 new ideas each year, even in good times. And that's the way we play it. So if markets go up, we do fine. If they go down, we've got a little bit of cash, but we own great businesses and they're going to be fine over the next decade. So it's pretty boring stuff, but I just think a lot of people are feeling so much pressure to do something, and maybe they've got cash and they're just wondering what to do. And that's sort of really the basis for the conversation.
I can speak from my personal experience, Nath, that over the last 12, 18 months, because I've had those coal stocks deliver really stellar returns, I haven't had the emotional damage of falling stock prices and the carnage that's gone through small caps. Some of my friends who manage small caps or invest in small caps, they are broken individuals. You can see it on their faces. You hear it in their words.
I'm just putting on the facade.
Yeah.
I'm broken on the inside, I can tell you.
I think that's something we don't give enough attention to, is the psychological resilience you get from not going to, or not having to endure all that pain. And I think hopefully for most members, or for some members at least, it puts you in a different frame of mind. I mean, we've saved up dividends. I'm sitting on the most cash I've ever sat on in my investing career. And I'm quite happy to see the market fall and wait for it. I feel absolutely no pressure at the moment. And there's plenty of ideas to comb through.
Do you think you would feel the same way if you hadn't invested so much in the coal stock?
Well, this is this is where I was coming to. During the GFC, I had luckily sold everything I owned to buy a property, and that was just complete luck. But I remember thinking I would have been completely wiped out because I was in stupid things, and I had debt at that stage, and I was just it would have been a disaster for me. And then when we had the big commodity crash of, well, I think it was 2011, 2012, that was also difficult. I lost a fair bit of money then, and I remember the psychological damage. It was hard to buy things again and to put cash to work because you're so scarred from losing money all the time. And I'm aware that that's not my mentality at the moment. I think that's a real advantage, and you really want to, if you share that position, and if you haven't worn the scars and you're not all damaged and broken the way so many investors are, that is an advantage. And make sure you utilize that. I mean, one of my top priorities this year is to make sure I use my psychological advantage and the spare cash I've got and put that to work at the right time. It's no good being
What happens if the right time doesn't arrive? What happens if the right time was 6 months ago?
It doesn't have to be the perfect time. It just has to be, or it doesn't have to be the right time. Just put it to work, right? I think that's a good disclaimer there, John. It doesn't have to be the right time. No, I'm not trying to sit around waiting for the right time. No. It's just looking for the right opportunity, I suppose.
Right. No.
Yeah.
I feel like I don't know whether this is right or not, but it's just my feeling is that the wealthier you are, the more easy it is to be patient. I find when you're not, I don't know, just a retiree who's sitting at home and the house is paid for and they've got their stock portfolio, there's really no pressure for them to do anything because there's a big difference between, I think, how you invest. There probably shouldn't be, but, you only need to get rich once, and how you manage your money once you're wealthy, whatever number you think that is. But it's a lot easier
to get rich once as long as you don't become poor twice.
Referring to divorces. When you're trying to grow your money and you just feel this innate pressure to be growing and doing something, it's much harder. And I even find that I'm trying to get somewhere, like I don't own a house in Sydney, and money is only worth what it is in terms of real estate. And, like if you live on a small island somewhere, $1 million Australian is a huge amount of money, but in Sydney, it doesn't even get you a 2-bedroom apartment. So you just keep seeing these property prices going way up, and it's like my portfolio is going way down. This is like, I just get frustrated. Like I'm never going to own a house, and then I just give up, and then I don't care anymore. But I'm trying to get somewhere. I'm at a stage in my life now. I've never really cared whether I owned a property or not in the past, but I'd actually like to have my own place now and stop just sticking around with the rents and whatever, and just have a place in the suburb that I like where I can spend the rest of my life. And, it's actually a bit frustrating that I can't do it. It's the first time in my life where I've really wanted to do something and I can't do it. I just have to give up too much of my portfolio to go and do that. And it's not a sacrifice I'm willing to make. But I sort of feel this innate pressure to get my portfolio going, and here it is getting absolutely smashed. But, I thought I'd actually prepared for this downturn pretty well. Like I had lots of cash. I didn't sell any Frontier shares, which is the one mistake I've made. And I knew it was going to get smashed. Like I was telling people, like this thing's going to get absolutely hammered in a downturn. But I thought if the downturn doesn't come and there's no big broad buying opportunity and we have our soft landing and all the rest of it, then at least I own one stock that I think will go up quite a lot in that time. But it's actually turned out exactly how I thought it would, and it's probably even worse, and it's probably getting worse. So it's been tough financially, but that's a very, I would hope no one else is investing the same way I am.
It's a good point, actually. It's something I've learned much later in my investing career, that the scars you wear financially are nothing compared to the scars you wear psychologically, and looking after your mind during a downturn and positioning your portfolio so you're in a position to not act irrationally or act in any sort of silliness. It's really important, and I'm trying and use. And try and put myself in a position to make good decisions rather than try and have the optimal, financial cash allocation. That's the way I'm trying to think of it now. I want to mentally be in the right spot to make right decisions, more so than trying to have the fine cash balance or the optimal allocation to this or that stock. And it's probably experience that lets you do that. But that's really surprised me.
I feel a bit more sort of philosophical towards all of this stuff now, where I'm kind of happier to I feel it's easier for me to let things go. So yes. I bought a few small cap stocks that just got utterly blown up, and I did sell some down before the massive blow ups, but I lost a reasonable amount of money. But do I look back on that and go, I really shouldn't have done that? Should I beat myself up? Well, actually, no. That was the nature of it. I knew what I was getting into. My probably biggest regret over the past year or so was not buying Facebook and Google. in single digit PERs. That's probably my biggest regret. But I suppose my attitude towards being wealthy is it's kind of different, I suppose, in that I don't feel as though we live in a society where people sort of judge everybody on wealth, and that has its own problems, and that adds to the pressure when you have something and then your portfolio goes down by 25% and you feel that loss aversion. Personally, like if you do have your own house, I think it makes it a big difference. You know, like psychologically, that gives you a sense of security that you don't get from any other kind of assets. I think that is important, Nath, if you can do that. But in terms of having, you know, lots of free cash to do what you want with, well, yeah, it's okay. But, you know, business class travel is good. You know, like that's a really a big advantage of being wealthy, and being able to eat out and eat good food is pretty good. But everything else, you know, like the very rich people I know don't seem to have any better quality of lives than I do. And in some ways, they have more complicated lives because all the kids are fighting over the assets and they're constantly asking them for money and stuff like that. So I think if you can bring, what would I call it? A more relaxed rather than grasping attitude towards money, then dealing with periods like this are a little bit easier.
It helps living in Australia.
Let me give you a little philosophical story, which I'm struggling with at the moment. And I know how irrational this is, but there's a little Canadian software company I've owned. I wrote it up on the website ages ago, and it's just not signing up new clients fast enough, and it's got some debentures that come due in a couple of years, and I can just see now that the people who own these debentures are just going to steal all the equity in this business, but it's too late to get out. Like, this thing's been crunched already. It's really illiquid. And that was actually part of the reason I bought it, was because there's some big fund managers that bought into it that were going to fix it up, whatever, smart people. Anyway, there's another stock I've talked about before called Celsius, which is a drinks company. And a friend of mine actually said he's buying some cans, so they must be getting around Australia now. And it's sort of a version of Monster beverage, but for a healthy version. Yeah. And so I bought these shares. Now I put 1/10 of the amount that I put into this Optiva, this little software company, and Optiva looks like it's on the way to zero. And so if I had to put the amount of money I put in Optiva into Celsius at the price I paid, I think it's only been 2.5 years, maybe 3 years since I bought it. That amount of money, which is a couple $100,000, would have been worth over $6 million.
Whoa.
And I'm sitting here with my portfolio just getting belted. And, the same analysis that I put into Optiva was the exact same analysis I put into Celsius or to Frontier or to CSL or to everything. And I think the one thing I've just got wrong is the portfolio allocations. And it's just killed me. And it's a really boring topic to talk about, but it's where the rubber meets the road, and it makes all the difference.
Yeah. No, I agree with that. It's a hard one to get right? I mean, if the outcome had been different for Celsius, you would have been patting on your back and saying how well you did getting the allocation right on that. You only really know in hindsight. I think it's a hard one. I struggle with that as well. I think it's really hard.
I think I just said it before about Druckenmiller, but he said in that recent interview that this was the most difficult period he'd ever seen because there's just no clear opportunities, and the only thing he was, and even he held this pretty loosely, and he changes his mind from day to day, but he was short the US dollar. But it's funny, I see shorting the US dollar because of the financial issues in America, but I look around the rest of the world and everyone's got them. It's just that they had a bigger blow up with their housing market than some other places did. I mean, Canada and Australia haven't had that, but their banks are up to their ears in it. And you look on other statistics and they're far worse than what these other countries looked like before they went into the GFC. So I'm not saying we're going back into that, but it's just there really aren't any easy options at the moment. And that's why my default, what I've been doing with the funds is just seen some of the results that recently have just been incredible. Like, we're supposed to, all the media pages are filled with all this bad news. And I'm just seeing like houses in our area, which they had 1.9 million on recently. There's just nothing to buy. There's just like one property in 1 month in one entire suburb to sell. And people have been paying 2.7 million for them. Like, it's just because it's the only thing, and they're sick of renting, and they just don't give a shit. They just want this over with. And, I see like ResMed like 30% growth in revenue and profit, like stunning result. REA Group putting its prices up from anywhere from 12 to 15 to 20%, stunning numbers. And so just, maybe it just reaffirms buying the quality stuff, but it's just, I think that's what's frustrating people is that you're seeing all this bad news and you read the media every day and it's just awful stuff to read. And yet you're waiting for these opportunities to buy these great businesses and they're just producing gobsmacking numbers. And it's hard to weigh up the stocks versus the economy, if you like. But that's a great point because it's all about stock picking. It's got nothing to do with the economy. We're not sitting here buying Boral or CSR or something where the economy really is tied into it and interest rates really do matter. We're buying very different businesses and we're talking about buying great businesses. Everything's tied to the economy to some extent, but certainly the best business in Australia, they're well in control of their destinies and they're showing it.
Gents, I just got back from the US. I went to the Berkshire Hathaway meeting for the first time. In fact, it was my first time in the US and the first time at Berkshire. Am I allowed to say that I was a little bit underwhelmed by the whole Berkshire experience? I just thought
I fell asleep by 11 a.m. the first time I went.
How could it not be? I mean, it's so hyped up. How could it not be?
It's so hyped up. Yeah, look, I had a lot of fun. I went with some friends and we had a lot of fun in the US together. And I met some interesting people at the meeting and some of the events around the meeting itself. That was great. But the actual 7 hours in a room with Charlie and Warren, not my best times. I actually found it quite dull. I found the questions, about half a dozen questions were asked by teenagers. They were just so boring. We've seen all these answers to these questions before. I'm not quite sure why this festival atmosphere continues. And I think we expect too much from a bunch of 90-year-olds. It's probably
kind
my
of like
last time.
Hillsong for value investors.
That's exactly what it is. And I was very uncomfortable with the cultish atmosphere. People cheer every word they say. I thought a lot of the answers were flippant and not very deep.
Far here now, Gaurav.
And there were some specific questions asked about specific stocks from shareholders of Berkshire, and I didn't feel as though Charlie Munger in particular, he seems to get cheered for being an angry old curmudgeon. I just think he's playing a character almost at this point. I thought he was a caricature. I was really disappointed. It's kind of funny when an old guy gets up and says an angry one-liner in a gruff voice, but I just felt as though this was an AGM, and some of the answers, if it was two other individuals talking about another business, everyone would be really annoyed about the answers being handed down. And these guys, I think they get a free pass because they're a bunch of cheerleaders in there clapping every word they say and cheering everything they do. And I just think that's a really dangerous setup. And I was quite uncomfortable with the whole thing. Yeah,
Last time I went was the first year that they had it online. And because you're in a stadium and if you're 6 foot tall, like you don't really fit in these tiny chairs and your legs are squeezed up and you're in there from really early in the morning. There's this poor bugger. I don't know what time you got in there, Gaurav, but in my previous job, the rule was the youngest analyst had to go and save 8 seats. So you'd have to get up at like 3 or 3:30 in the morning, get in there at 5 or whatever time the doors open, and then save 8 seats until we come along when we feel like it. Like it's just everyone's trying to get these seats in the main stadium because there's breakout areas now anyway, but you don't want to be in there watching that. You want to be actually at least in the stadium.
We were lining up at 5 a.m. 5 a.m.
I'd had enough by 11 or 12 o'clock, and at lunchtime I just went back to our crappy hotel and I watched the afternoon session lying on the bed.
Yeah, it seems pointless to me. I went to the Westco AGM probably about 12, 13 years ago.
Yeah.
It was probably one of the best days of my life. And that was only because Tottenham were on the verge of getting Champions League and they had to beat Man City, and Peter Crouch scored a header with 5 minutes to go and got 4th spot. And I saw it in a pub right next door to the Westco AGM, which showed English football, served English beer, and did sausages and mash for breakfast. It was an unbelievable day. And the worst part of it was the Westco AGM, where all the sandwiches disappeared in 10 minutes because value investors.
Yeah, I noticed that as well.
I resolved there and I thought, okay, I know everybody wants to go to this stuff, but it just wasn't for me.
Yeah. I think you're early on that piece. They gave away some free food at the AGM, and yeah, a bunch of value investors. Most of these people are worth millions, I might add, all scrounging for free American muffins. Geez, the food in the US, and may I say, with the greatest of respect, that Omaha is a shithole. Like, it was just, it may be the ugliest city I have ever seen. I was there for a couple of days, did not see one pretty building, one nice tree. It was horrible. And the food is
cheap.
inedible. Yeah, it's cheap. It better be. It's the only thing that's cheap, because everything else was super expensive. Anyway,
the one thing it does these days is there's a lot of investors get together on the sidelines and have their own little things, but unless you know those guys and you're not part of it, then you miss out on them. But a lot of those people just get together. You know, most people would be from New York anyway, or the Eastern Seaboard, Boston. So, you know, they get together in their own things anyways. So it's always been a question whether people would still come to see them after Warren and Charlie were no longer there. And I suspect they will, but it won't be as big, because I think people will still be there to catch up and reminisce. And it's for a lot of people, that's probably their most thing they look forward to most on the calendar.
Without doubt, that's the most fun part, is actually just hanging out with like-minded people. But you can do that without the 5 a.m. wake up and the 7-hour meeting. You know, look, one thought that did strike me was that, you know, they've got a lot of the Berkshire businesses with stands at a very large convention center, and you can go around and see all the things that Berkshire owns. And it really struck me that we have this idea of Buffett as owning these really high quality businesses, and most of the companies that had presented at the convention, I would say mediocre or average businesses. And it really got me thinking about our definition of quality. You know, I think it can be very narrowly based, and we tend to think that a quality business is one that has the biggest moat possible, and that's the only definition at all. But Buffett owns things like I didn't know this, but he owns Brooks, which is, I think, a third-rate sneaker brand. Russell Athletics, which is a second-tier brand. Fruit of the Loom, which is a Cotton On replica, and this business that makes these squishy toys, which I would have thought has zero moat around it. But all those businesses, they perform reasonably well. And I just think sometimes that we get caught up about having, you know, the beautiful set of financials and a great big moat, and often management and reinvestment opportunities and the runway, the growth runway ahead can be substitutes for, you know, the big moaty business, and they probably have been for Berkshire.
Some of those businesses might have looked a lot better 30 years ago when they were bought,
perhaps,
and what they look today. You know, especially Brooks. I mean, there's lots of other running shoes in the last couple of years. What's those Allbirds or whatever, and there's another couple lightest shoes ever, and technology's changed. You know, you can make much different sneakers to what you used to. They're made out of much different things. So
absolutely,
you sort of look through that lens of, this looks terrible today, but maybe 30 years ago it was a bit more unique, and people getting into running, and maybe there was room for Russell Athletics and those things after the Nikes and Adidas, which maybe weren't quite so dominant back then.
I think he's still doing well from them. The returns have been okay, but just the just not what I expected to see there. That's all. John,
sorry, can I just say something?
Yep.
The one thing that I think is quite interesting at the moment, and I'm careful, I don't want this to come back on our returns at some point, because you know, you don't want to be calling the kettle black. Or this is something in Morgan Housel writes these articles, and I love reading them, and sometimes I paste them somewhere, but he talked about sometimes when people, you can actually get quite nasty when you hear fund managers talk about other fund managers and or other investors. And he was talking about, he said that one thing he's realized as he's got older is that a lot of the things that people complain about is just actually these people are just either one, got a different strategy, or two, a different timeline. You know, they're just trying to make money faster, or, you know, whether they're more tradey or, you know, that sort of thing. And so what we're actually complaining about is just that they're not the same as ourselves. But just one thing I've noticed lately, I can't remember whether I talked about this before, but we've just seen it, the devastation I've seen on a lot of funds that were riding so high up until 2021. They've just been absolutely demolished. But when you've got a fairly short-term record, because I follow a lot of these small hedge fund managers in the US, because I just like hearing about unique ideas, and they cover some microcaps and stuff I've never heard of. And actually haven't had any good ideas out of there for a long while, which probably shows you how much value's out there. But I was amazingly, and this is sort of where Berkshire Hathaway's sort of involved, but there's all these great investor names that are absolutely revered. And Berkshire can't, even Munger says, like, we can't do anything better than the index. Our business is just so big. That's all he expects. But, if you're one of those Berkshire billionaires and you're not going to sell your stock, you're going to be happy with that, and you're not going to create a big tax problem and whatever. But interestingly, Tweedy Brown was one that I just remember when I first started becoming into investing, was this huge name. And you may remember, I can't remember what year it was, maybe it was 13, 14, 15, somewhere around there, was the big pharmaceutical company Valiant. That I'm pretty sure Tweedy Brown invested in them. I may have them mixed up. I don't think so. Anyway, or it might have been Ruin and Carnif, and so I've mixed them two up. But anyway, the point's the same. These guys that had these just incredible track records, and I think it was Ruan that when Buffett closed his shop, way back when, and then before he got into Berkshire, he said, like, invest with Ruan. This guy's great. He invests like me, and it's all good and done superbly. And then they all come unstuck with Valiant Pharmaceuticals, which basically came up with the ploy that you can just go and buy other smaller pharmaceutical companies, cut out the marketing, skyrocket your prices, and don't do any capex, like don't do any R&D. And that worked for a little while. And then I can't remember which one it was, but it got to the stock got to something like 30 or 35% of their fund. And one of the older names there that you would think would be the most sensible and conservative names said, no, we need to keep this. And then it blew up spectacularly. And it's actually, I think Netflix had a story on it, and John Hempton was on there talking about the short case and whatnot.
Yeah.
And the returns of that fund now, even though it's been around for 35 or 40 years, like if we have a bad, 6-month period like we have recently, like that moves our since inception numbers around quite a bit in our funds, because they haven't been around very long. But it takes a lot to move around the since inception numbers for a fund that's been around for 3 or 4 decades.
Right.
And I was looking at the returns for Tweedy Brown the other night, and I just remember when I first came into investing with Greg, and just Tweedy Brown, I don't think it was Greg talking about this necessarily, but just all the stuff I was reading about Buffett and whatnot was Tweedy Brown this and Tweedy Brown that. But their returns, I think since the early 70s now, are like 5.6%.
Wow.
And I said, so I'm sitting here and thinking about all these people getting frustrated with their returns at the moment, and even my personal money getting torched. And I was even thinking about my own money and going, geez, Frontier, I should have sold some and just carried a smaller positioning, because what's happened is exactly what you said was going to happen, and whatever, I'm castigating myself. And then I think about Sean, who's the CEO and founder of this business, who he's hit a home run with Zameen, and he's hit a home run with everything he's touched so far, but the currency is the only problem here, and it's just smashed the value in Australian dollar terms. But he has not chosen, he has won big time every time he's touched something, and his value, his shareholding in the business has gone from 40 million to 10. And so my losses are pretty big, but they're not actually, from what I paid, aren't that big, but from what I had, it's come down a huge amount. And yet here's this guy who's lost about $30 million. And then it's like you sit here as the investor going, Frontier's got this, no one wants to own it, it's going down and whatever. And you go, well, actually, what's going on in this business at the moment? And why is this guy, I see him on Instagram, like with a big smile on his face and getting around, and he's not getting paid that much in Frontier. And this guy's not worth $100 million or $1 billion or anything. I feel like I'm under pressure, but it's self-imposed pressure. And I'm thinking, like, why is this guy smiling? Like, why is he so comfortable watching his go from 40 to 10? Like,
it's kind of a law, Nathan. You can't be miserable on Instagram. I don't know if you maybe that's it.
Hey, John,
we've got 15 minutes left, so maybe we can move on to.
Yeah, I was going to say that at that Berkshire conference, they spoke a little bit about AI, and I just wanted to get your thoughts on that. So Munger, I think, said quite surprisingly that he thinks a lot of the hype around AI is probably unjustified, and he thinks it's unwarranted. I just wanted to get
in what sense?
He didn't really elaborate on that. I mean, the guy speaks in sentences, in single sentences, so goodness knows what he means. But I want to get your thoughts on it. I mean, this is probably the amount of hype I've seen around AI is probably the equivalent of the hype we saw in '99 around the internet.
Yeah.
And that we could see a corresponding boom in AI stocks. We just don't seem to have any on the ASX listed. Not many that I know of, anyway. Give us your thoughts on where we are on AI. I think you had some thoughts on Google in particular that I'd be interested to hear.
Well, I should preface everything by saying that I really know nothing about this.
Oh, good. Excellent.
I've read a lot about it. I have a friend who's a professor of AI at RMIT. Whenever she talks to me about it, I feel as though she's talking in Portuguese or something. I have the same sense of confusion. But Nick and I and Nathan, to a lesser extent, have been talking about this a lot in the context of Google. And what I think is interesting about that situation is that I've always thought that AI is about, you take large data sets and you apply massive processing power. You find all of these relationships within the data that allows you to then make some conclusions about what's being asked of the chatbot when you type something into ChatGPT or something. And that compute power was really a barrier to entry. So OpenAI, I'm not sure what the number is, but OpenAI have taken billions of dollars as an investment from Microsoft, and they've largely used all of that as server power. And so I've always thought of that as a competitive advantage, a little bit like data centers. So we've got the second part of the Amazon story coming out in the next week or so, where we look at AWS, and it's the same kind of thing, that it's so expensive to get into the cloud business. You can see this at NextDC as well, is that most companies just do not have the capital or can't access the capital in order to establish a position in it. So if the cloud computing companies we've got now are highly likely to be the cloud computing we've got in 10 or 20 years time, I think. And I applied that kind of logic, which I thought was sound, to AI as well. And in the same way that I think Google and Meta and Microsoft have done and OpenAI has done. So one of the interesting things that's happened in the past few months is that Meta, Facebook, have their own AI models, and unsurprisingly, one of them was leaked onto the internet. And you think, well, what can people do with that? You need a massive machine to just hold that level of data, and you need huge computing power to process it. And what happened was within a few weeks, people running scaled down models of large language models, LLM AI, on things like Raspberry Pis and Pixel phones, and coming up with results that probably weren't quite as good as what Google or OpenAI might do. But the convenience of having it locally, say on your iPhone or on your laptop, massively outweighed the fact that the results were maybe 5% worse. So when was it? Let me just have a look. So I've got the memo here. Memo came out a couple of weeks ago from Google, internal memo that was leaked called "We Have No Moat." So which said, we've done a lot of looking over our shoulders at OpenAI, who will cross the next milestone, what will be the next move. The uncomfortable truth is we aren't positioned to win this arms race, and neither is OpenAI. While we've been squabbling, a third faction has been quietly eating our lunch, and that's open source. And they go on to list all the different things that are happening in open source, and this thing is now out in the wild, and there's people in garages with a few servers stuck together who are doing amazing things in Romania. And that's only going to accelerate the pace of change and the number of products that we're likely to get. And I think that before we started looking at this, we probably looked at Google and thought this was a buy. And we only put it down as a hold because it is a fundamental threat to their search business. And I think Charlie Munger's probably wrong. I don't think this is a fad. I think this is every bit as important as the internet was 20 years ago. Maybe more so.
So just to clarify, John, you're saying you reckon that OpenAI may not be able to monetize what it's done so far, and in fact, the providers of AI may just spawn more competition.
That's right. So Google, the argument that this is made in this memo is that we're better off letting 1,000 flowers bloom and taking advantage of that and doing, say, what we did with Android and having this open source model and seeing what it produces, rather than trying to control it ourselves, because
Interesting.
it's fundamentally out of control now.
I always thought because the inputs, the data that you train your model on is so
Yeah.
important.
Yeah,
That would
that's where
be the
impact
secret
comes in.
sauce, and that would create an incentive for the Googles and the open AIs to hold
Okay,
tightly onto their sources.
So this is the key paragraph in that
Yep.
sense. So while our models still hold a slight edge in terms of quality, the gap is closing astonishingly quickly. Open source models are faster, more customizable, more private, and pound for pound more capable. They are doing things with $100 and 13 billion parameters that we struggle with at $10 million and 540 billion parameters. So they're doing more with much, much smaller data sets and smaller parameters and producing almost as good results.
Okay, maybe don't buy Google just yet.
No. I mean, there's still lots of things about Google that are there to love. You know, like we presuppose that just because the technology gets better, that we'll switch. But you know, most Google searches don't involve advertising. That can easily be handled with a chatbot. Google's AI products might be behind ChatGPT's, but they could probably close that gap within a few months if they wanted to. If they worked hard enough at it. And if they went open source, they could probably do it more quickly. It's only with the shopping related or say the insurance claims related answers where they will have to combine sort of display ads, as you see in Google Shopping. You know, when you see all of those images across the top, you can scroll, you know, across. I bought a walking stick like yesterday, which hopefully will be delivered soon. So I can get rid of the crutches. You know, it's things like that, which could be answered with a chatbot. Say, what's the best walking stick under $30? And you just get a product and a link to it. It's not as lucrative as having 20 different options, each of which Google gets a trailing or affiliate marketing commission from by sending people off to these websites, plus, you know, the ad spend as well. So there is a threat there to its business long term. And it's a classic example of the innovator's dilemma, I think, Clay Christensen's innovator's dilemma. So that's really one to watch.
Can I just throw a book recommendation out there before we sign off? I finished reading Chip Wars by can't remember. It's a famous book. You'd know it if you're interested.
I've heard the guy interviewed a few times.
Have you read the book, John?
No.
I would caution you about reading it because it is so badly written. I think your head would fly off if you read it out of frustration.
For me already. If you think it's badly written, then
yeah, it's badly written. He jumps.
This is from a guy who doesn't use apostrophes. He thinks the book is badly written. Like, does he have full words? It doesn't use vowels.
It's an amazing story, badly told. I think he tells a story really poorly as well. But there's a fantastic tale there. It's frustrating that it's in the hands of this author who cannot write and cannot tell a good tale. But despite that, there are some really interesting tidbits. I think the thing he does very well is explain some of the technical. The deep technical aspects of chip design and chip manufacture. And I think most people will be absolutely stunned to know the amount of innovation and accumulated human knowledge that's required to print a single chip. He gave an example of you know those light printing chip machines that ASML make.
The Dutch company.
The Dutch company, yeah. So he's saying there's 3 separate innovations. Each of them took 30 years to complete, and so there was, you know, a century of innovation almost. It had to come together and to create that light printing technology. And without that, we wouldn't have the modern microprocessor. So those sort of things are quite interesting.
It's kind of that is an interesting thing in an investing sense, I think, that because there's this reasoning, and you can maybe see this in Chinese thinking, where you say, well, okay, we'll just produce a load of scientists and we'll throw tens of billions of dollars at it and we'll catch up. But it's kind of like you have to go through those 20 or 30 years to learn all of those things and make all of those mistakes before you get to that end point, which is, you know, a 5 nanometer chip or something that does billions of transactions a second or something. there needs to be that accumulation of knowledge and skill and expertise over time. It's kind of like a sort of super version of a jet engine. There's just so much in it that the only way of producing it is to have all of that corporate history that allows you to arrive at a certain point in the future.
Absolutely.
And unless you travel along that same path, you don't get there.
I used to think science was this body of knowledge that was just out in the world, and it was only a matter of time before someone stumbled upon it. But reading that book, and I think a few adjacent books as well, has really made me think that the role of that individuals play in innovation is just absolutely crucial. That entire chip industry, all the innovation we rely on every day, is the product of maybe 4 or 5 people. And absent those 4 or 5 people, I wonder what would happen. I think the role of individuals in big science is just is probably underrated, and it's made me think a little bit more about that. But yeah, that's one book. The other one I'm reading at the moment, which is actually beautifully written and wonderfully told, is Lights Out: The History of GE. And
really?
I went to that because I'm, as for my first 20 years as an investor, GE was the model business.
It was the stand-up. Everybody talked about Jack Welch. He was like
absolutely
the Warren Buffett of the business world.
He was
absolute saint, could do no wrong.
And I admit that I like reading about fallen gods.
Yeah, same here.
But this is a well-told, well-crafted book. I'm only about a third of the way through it, but I'm thoroughly enjoying it so far.
So what if you could pin
a
reason for the downfall of GE, what would you put it down to?
So GE was actually, keep in mind I'm only a third of the way through it, but it was riddled with accounting anomalies. I mean, every division, there was exaggerations, dodginess, and sometimes outright fraud. And the reason all that existed was because the pressure to perform, to not make any mistakes, and to always get your guidance on target. If ever a manager produced a set of numbers that wasn't satisfactory, that's the end of their career. A failure was just not accepted at GE, or any sort of disappointment was not accepted at GE. And that just created a whole bunch of incentives for bad behavior by the line managers, and that filtered all the way down. So I think this is, I've kind of paid out Munger a little bit, but one of his key insights is that incentives matter. He often says, show me the incentives, I'll show you the behavior. And I think that's been absolutely true here. The whole thing was just, the whole business was run for the benefit of analysts and investors. And you can see that all the way through, the way it was managed, the way products were created. You can see that all the way through.
Yeah. I haven't read that book. I've read a lot about Welsh over the years because, like you, I am interested in fallen gods. But I could probably cast it in a slightly different light, in that I would look at GE as one of the sort of poster child for the era of financialization. So this is an engineering company with a great history of technological advance that is taken over by accountants and managed for financial reasons rather than for scientific or engineering-based reasons.
We haven't got into GE Capital and the role that played, but I bet that's a big part of the next few chapters of the book. Yes, I agree. Yeah.
Yeah. Okay.
Right, Nathan, you've been quiet for a while.
You did talk a lot at the beginning. Like, he's just having a break.
Keep in mind, I just did a webinar right before this. So I'm sure people are going to have heard enough of me.
You're going to headbutt the microphone in a minute and just fall asleep in your seat.
I would just say, just quickly, so we own a few of those companies in the international fund, and I just come back to the Druck's comments about just, I'd say we're probably diversified against our ignorance. Like nobody knows how this is going to play out. But I think that key point is you feel like the internet's been around forever. It really hasn't been around very long, and now is these sort of early winners are now facing their biggest challenges ever here, and there may not be winners out of this. Like you said, it might just be a bunch of losers. The playing field's just much more level now, because what can only be done by a couple of specialized companies now can be done by someone sitting at their own computer. So we don't have massive positions in any of those tech stocks, but we've got about, I think, 10% in total, and sort of spread between 3 of the big ones, Microsoft, Amazon, and Google. And that way, if they work out well over the next 10 years and capitalize, they'll do their bit for the fund. But The beauty of an international fund is you can be more diversified and still have the same returns than what's available in Australia.
You know, one more thought from me is that every time I read about a business that's imploded or a business that's a poor quality or that's been poorly run, I can't help think about Apple as the comparator, because I just think that is an amazing business that's run by the right people for the right reasons with the right incentives. And I don't think I've ever been as impressed with a business as I have been with Apple. I say that as Apple shareholder, mind you, but you know, I was reading through the way GE was structured and the incentives all the way through GE, and you know, then comparing that to what I know about Apple, and it's just completely different. And I just think it's head and shoulders above almost any other business I've ever seen. That's my pitch for getting it in the fund, by the way.
Well, I think you could look at AI as well, going back to that, and just say, well, if you look at Siri, first sort of voice assistant, absolutely terrible. Has done nothing in 10 years, maybe longer. But it's got how many users are in the Apple ecosystem now, Gaurav? That's got to be getting on for 1.5 billion.
That's right, 1.5 billion, somewhere in there.
Absolutely locked in. If this does go open source, then it could be a huge boon for Apple. Everybody's got little chat GPTs on their phone. Could be amazing for Apple. Probably not so good for the rest of them. So yeah, probably shouldn't have sold 2 or 3 years ago.
I think we sold down half of ours as well. I still got some left though.
I think that's one of the benefits.
China is always a big risk.
Yeah, it is. It is a big risk.
I think that's one of the benefits of finding stocks early in their life cycle. Is once a company's gone up 8 or 9 times, or many more times that in the case of those stocks, it's a lot easier to think about what you should do then, rather than having missed all that. And now coming in going, well, should I buy some now? Like, Google looks really cheap on a statistical basis, but is this the beginning of the end? And that's a really hard decision to make. It's just a lot easier when you've made 10 or 20 times your money.
So true. Which brings us back to full circle. Put yourself in the right psychological frame to make good decisions. Gents, thanks for joining me. Nathan, John, you don't get a chance to talk to you on the podcast very often, so it's a real pleasure. Thanks to both of you.
No, thank you. It's been good.
Thanks, boys.
Apologies to Steph for not getting this sorted out.
Yeah, sorry, my fault. Technical error on my behalf. I'm still.
Gaurav's been sending emails to himself all week. Apparently,
all my emails haven't been sent this whole week, and I just.
To be fair, though, it's not the only time it's happened. So I would appreciate you letting me know as soon as you know that you're going to do a podcast.
All right,
that was Steph. Everybody,
that was Steph. Yeah, telling me off.
It's about time we introduced her to the membership.
And
she's been a long-suffering staff member for decades now.
I'm so sorry. I thought you'd finished. I can cut that out. I'm editing it out.
No, leave it in. No, it's good to have your voice on
the audience will love that.
Leave it in.
Oh, shit.
Absolutely.
Now, maybe just bleep out the swear words and we'll be fine.
No, that's okay. It wouldn't be Steph for that if you swear words.
No, that's right. That's true.
Okay. All right.
Well, everyone, thanks for listening.
Thanks, everybody. See ya.
Thanks, Steph.
Cheers, boys.
Oh, sorry. I had the volume way down low, and I thought you were just jabbering on after the end of the podcast like you do, and jumped in at the wrong time. Sorry.
That was funny. It was funny. Don't worry about it.
No, that was good, Steph. Leave it in.
Yeah. You got to leave it in. I agree.
Fantastic.